Welcome to this walkthrough of the updated oil and gas financial model template. The purpose of this spreadsheet template is to analyze upstream oil and gas drilling projects and derive the financial projections and then calculate all the relevant key metrics to analyze the feasibility of such an endeavor. Before we start with the walkthrough, if you'd like to see more videos from us, please push the subscribe button and please also visit the link to the template included in the description below. The structure of this spreadsheet template is that we have here different worksheets. I'm here now on the executive summary sheet, which basically summarizes the key outputs of this model and results in the financial key metrics, which can tell you how attractive this project at the end of the day is. We have extended summary, which summarize starting from the financial projections, but they also give you more breakdowns of all the financials. Then we have one main sheet which summarizes all the assumptions. As you can see here, there are various types of assumptions we need to collect. I will just walk you through in a moment. We have a sheet which lists all the oil well drilling projects. We have a sheet with the modeling of the depletion curves. So when the oil production, normally typical for oil and gas drilling project, is that the production peaks first and then the pressure decreases and also the production will decrease over time. And in order to model this, we need assumptions to model the depletion curve and the likely decline of production levels. We have one worksheet which goes into details well by well what will be the production output for oil, gas and natural gas liquefied. We then build a 5-year monthly financial plan for the first 5 years. Then we populate the spreadsheet with a 30 to 50 year financial plan. We have an assumption on the assumption sheet which we can set to as many years you like, and depending how many years you like to include, we can either extend or we can limit our financial forecast. Another sheet goes into details about the profit sharing between general and limited partner. We have another worksheet which analyzes the break-even price. In this case, is the break-even price for producing gas. Two ways to look at it. We even look at the required price to get break-even, or if the price is fixed, the required volume. We also have worksheets in here with instructions which you can work through. This basically details the suggested work plan, how to work with this template, and also a sheet where we have listed all the terms and abbreviations. So in short, this gives you an overview about the structure of the template. And now let's dive into the details in how to use this spreadsheet template. The way to start is to look through the assumption sections. And as you can see here, we have here a general settings section. We can set currency and the first forecast year. It also specified what will be the main type, if it's an oil well or gas well. This depends on your production plan. So if you have the majority of revenues in oil, it will be an oil well. If you have the majorities of your revenue in gas, you will have a gas well. These other assumptions are standard placeholders needed to calculate or designate the volumes and the conversion ratios between these different types of output labels. If you feel like you want to use other labels, this would be the place to change them. Assumptions regarding valuations, what is the discount rate you want to use. And we have assumptions to value the reserves. As you can see here, we only consider 75% of the expected revenues of the reserves, and we also only include 10% of its value because we say this is the value today and what we have calculated with the value in the future. Other assumptions here are business assumptions. These are at the moment standard. I suggest at the moment to leave them and come back once the model is more set, to fine-tune them. What we need to do now is to define for this oil and gas project what will be the drilling programs. And as you can see here, we have placeholders for up to 8 drilling programs, and each program can include a certain number of oil wells, and you can just change them. Important is that this model was designed here up to a total of 100 oil wells. If you have more, we will only consider 100 oil wells. Each program can start at a different point in time, here measured in months. So it's month 13 means that's the first month of the second forecast year, the month 25, the first month of the third forecast year. And the idea is that you could first focus on drilling the first program. This might take, for instance, a year, and drilling a couple of wells might take 3 months. So what we do is we just distribute the 15 wells over a period of 12 months, and then this will be drilled. And as you can see, we also have then the assumptions here, what will be the output at the peak production in terms of oil, barrels per day, gas, the million cubic feet per day, and natural gas liquefied, also measured in barrels per day. So that would be to indicate the starting levels of productions, here measured by oil well, and then if we multiply the output by the number of wells, we get the total daily output for each of these drilling programs. If the first program reaches production stage, the nice thing is that there will be already revenues coming in from the sale of oil and gas, and this revenue can eventually be used to finance the other drilling programs. That's why we have separated in this spreadsheet these drilling programs. If you don't want to do it, you can just set that you start all the drilling programs at the same time, you define how long it will take, and then the production will start all at the same time. So far we have entered assumptions to estimate what will be the daily output at peak production times. But in reality, these oil wells, they actually decline, the output declines over time. And what we need to do is to model the decline rate of these production levels. And what we do is we have here a sheet where we can, for each drilling program, we can estimate by how much each year production levels will decline. And we can set this instance here, and so it means that by year 10, in this case, we are at 75%. Of course, these assumptions are just examples only, just to give you the idea. You will have to analyze yourself how much your experts think these production levels will decline for your specific drilling programs. Then the next aspect we want to also consider, we list here what is the expected size of the reserves by program, and this then also allows us to do a valuation. So if we can say each of these volumes, they can be valued at a certain oil and gas price. This will give us the expected future total income, and then by using these valuation assumptions for a quick estimation, what could be the potential present value of these reserves. Another factor we want to keep in mind is we need to be sure that whatever we input here in terms of production level is covered by reserves. So we want to know how many years of peak production we could sustain, and we just want to make sure there are enough reserves there so that we can execute our production plan. The next topic we need to look at are the drilling costs for these programs. We can do this by estimating the cost it takes to drill one well and then multiply by the number of wells, and we get the expected costs for these drilling programs. These drilling programs are then added to the CAPEX, capital expenditures budget for this project, which might also include costs for property, geological study, roads, infrastructures, and similar investments. And as you can see here, we have here assumptions to either count for them at the beginning or in the first year, or move these costs around as per our project plan. We then continue by reviewing the output, the projected output of our project. And as you can see here, we have here now the total gross output resulting from our drilling programs, now plotted by the forecast years. Not all of this output will be commercially usable, so we have to apply a percentage, normally 75-80%, for instance, of the gross amount which is sellable. We do this for oil, gas and natural gas liquefied. Eventually there might be other income related to this project. This would be the place to insert them. Now we also need to define the pricing assumptions of our financial plan. We do this by setting the oil price as the base price, and we can project either to stay stable or to increase over time. The gas or NGL price, we can either assume that they move in tandem, so all we have to do is to set the relative ratio and they are assumed basically to always follow the same relationship. Or if this should not apply, we could also set the pricing differently. This will then result in the revenue projections, and here you can find a quick summary of the resulting revenues provided from our oil and gas wells and the NGL output as well. Up to now, we have collected all the revenues we need to estimate revenues and CAPEX, and now we also need to estimate the costs which are needed during the operations of our oil and gas wells. We might have costs which are related to the amount of revenues. For instance, resource taxes, these can be different for oil and gas, but we also might have costs for transporting our producers, so this we can enter as a cost per barrel or as a cost per 1,000 cubic feet of gas. As well, we might have costs which are related to the operations of our oil wells. So these we can estimate how much does it cost to operate one oil and gas well per month. And that would be the assumption here. And then we can also have other indirect costs which are related to the whole project, and we can just estimate how much these should be per month. Then we have a uses and sources of funds table now. This is now to obtain an overview what will be the total investment amount required and how we're going to finance that. And as you can see, our calculation starts with all the CAPEX positions we have identified to pay for the land, the infrastructure, but also the drilling projects. There will be some capital needed to build up the initial net working capital, mostly receivables and inventory, less payables at the beginning. And we might also have costs for the setup, and these will then all be added together. And as you can see here on the right side, the model actually calculates, if you follow the track, we say the equity is what we need in terms of minimum funding plus a cash reserve. But we also see that this amount here actually is what the model calculates we can obtain from operating cash flow during the ramp up of the project. The reason for that is our phasing plan, and that we are drilling these oil and gas wells in a staggered way. So that means in the second year we already have oil wells from the first drilling program in operation, producing cash flow and helping us to finance the drilling of the other oil and gas wells. So this contribution is then what shows up here. The last set of assumptions needed are assumptions which define the relationship between investors, general partners and limited partners. What will be the equity stake they will receive into the project? Who will contribute how much of the funding required? We also take into account a potential profit sharing model where we can say until the capital is repaid, the general partner will receive X amount of the profits of the limited partner to compensate for managing the project, and this percentage is foreseen, and it is foreseen in this model that the percentage could get can get higher if once the capital has been repaid. Now that we have entered all the assumptions, the model will define which wells need to be drilled and to which drilling program they belong. The model will calculate the suggested schedule on the timing of the drilling starts. The duration will then give you the time of completion of the drills, and at that time the production will start. And depending on which drilling program this well is allocated, it will pull the respective barrels per day or the million cubic feet per day to be produced at that location. Then we have here a quite detailed sheet over the whole forecast period starting with the allocation of the drilling CAPEX, the ramp up of the production. As you can see here, we are phasing the start of the production. More and more wells have become online, and their production levels, they stay at peak in this model, assuming for 1 year, and then they will slowly start to decline. Every year the production will go down. So we do this calculation well by well to get quite precise on how the output is to be expected. And then once we have done that, we can basically calculate how much oil we will produce by which month, and the same for the gas and the natural gas liquefied. We have then a monthly sheet which translates the production outputs in revenues and costs. Then we'll take into account by when the oil and gas wells reach production stage and when they will start to generate revenues. The costs and then the CAPEX is pulled from the other sheets so that we can forecast the whole cash flow statement, and we can also track the cash balance during the first years on a monthly basis. Here below are all the schedules which form the supporting calculations. If you need to look up from where one figure is calculated, there is a nice menu here which is Tools Auditing Trace Precedents, and it gives you the indications from where these figures are calculated, so that you can actually have full transparency on how this forecast is being built. The next schedule then is the yearly schedule. As mentioned before, we aggregate the monthly schedule and we continue during the whole forecast period of the project. And so we can obtain all financial statements, financial ratios, and calculate the free cash flows, which then are needed to calculate the financial metrics. Maybe the best way to understand the results is first to look at the executive summary sheets. Here is a summary of the P&L in short. And you can see that what's happened here is that we ramp up the production as more and more wells comes online, and then suddenly the revenues slowly start to decline, or depending on your completion rate assumptions might be faster, so that we can see how this will develop. At one point the production will stop. And we can also understand here which of the drilling programs will contribute how much to the revenues of the project, so we can see which ones are most important. If you would like to exclude a drilling program, for instance, this one is the biggest, so let's exclude this big gas wells here. And then you can see the project would look like this if we would not have the blue drilling program. And you can also look at this scenario and see the impact on the expected IRR. Now you can see without this well, the project would not be profitable. So we have to go back and adjust the assumptions or find the scenario which is profitable. On these sheets, basically, there are all kinds of further schedules included to understand the financials of the projects, and also on the extended summaries, even more breakdowns and tables to understand the financials. There is also a sensitivity table included, so what would happen if the gas price would increase, for instance, by 5%? Actually, all the prices, not only the gas price. And what would happen if the production levels would be higher or lower, so we can see a bit the impact on the IRR in that case. And there also a summary of the break-even prices for this project. Here is all calculated for gas, because The project type is the main output or main revenue contributor from this project is gas, and that's why we look at it from a gas price point of view. So I hope this walkthrough was useful to give you an overview what this model can do for you. If you like this video, please give it a thumbs up, subscribe to our channel and visit our website efinancialmodels.com. A link to the model is included in the description below. Thank you for watching.